So this paper is with Dongqiang Liang, who is my PhD student. He's actually going to have his viva in a couple of weeks, so he's almost finished and he already found a job. So yeah, I'm a PhD student for another couple of weeks and that's it. So he will help answering any questions later on. So the title is about sailing in a storm. And so we want to understand how firms navigate the actual winds of uncertainty. So I'm going to start and give a little bit of background and then talk about our contributions to the literature. Then I'm going to talk about our data and variables, including our novel measure of uncertainty, and then the results, and then some conclusions. Okay, so this is just like a stylized fact. So in this picture, we represent both the fixed asset investment in China, which is red, and the economic policy uncertainty index in China. So this is just aggregated data, macro level data, but it's enough to get an idea of the fact that there seems to be an inverted relationship between the two variables. So you can see that when the blue curve goes up a lot, the red curve goes down. So there seems to be kind of an inverse relationship between the uncertainty measure, which is again an aggregated measure, and the fixed asset investment at the macro level. So we want to dig deeper into this and seeing whether, focusing on individual companies, whether these two trends are related or not. And so we're going to focus on investment of the firms, of the companies, but then what about uncertainty? Because this blue curve is just like macro level uncertainty, economic policy uncertainty. But if we want to focus on firms, we need to say something about firm level uncertainty. And we want to understand how firms will react to negative uncertainty shocks, but uncertainty at the firm level. So we need to construct a firm level uncertainty index. We need to measure uncertainty at the firm level. Okay, so let me give a little bit of background on how uncertainty affects investment. So there are like a couple of theories about it. So the real option theory, it says that if there is investment irreversibility, if investment is irreversible, then when there is uncertainty, firms will postpone their investment. What does that mean? They will want to wait and see, because investment is quite costly and stuff like that. So the moment uncertainty hits you, you are not sure whether it's good or not to invest. But if you invest and then it's bad, then it's very costly to kind of divest. So in the presence of irreversibility, if there is uncertainty, firms will wait and see. And this is theory from Bernanke back in 1983. However, there is another theory, which is the growth option theory, which was proposed by Atanasov in 2024. And they focus on research and development investment. And then they say that if there is uncertainty, then if firms invest initially quickly in R&D, then they will want, this will enable them somehow to build competitive advantage. So if there is uncertainty, I want to build that competitive advantage. How do I do that? I invest in R&D. So from an empirical point of view, the results are a little bit mixed. Some people found support for real option theory, and so they found a negative relationship between investment and uncertainty, which is primarily due to investment irreversibility. But other authors found a positive relationship between the two variables. They say that when there is uncertainty, then the opportunity cost of waiting may go up. So if there is uncertainty, you want to invest, especially in R&D, according to Atanasov, you want to invest in R&D straight immediately. So uncertainty leads to a positive investment in R&D. So this is what literature has found. But now we want to move on to kind of more like firm level at the firm level, we want to look at micro shocks that affect firms. Why is that important? Because if there are some firm level idiosyncratic shocks that hit firms, they also play a very important role in determining the business cycle, the aggregate fluctuations. Especially in recession, we start with some shocks at the firm level, then more and more firms are affected, and then we end up with maybe a recession or something like that. But the question of how firm-level shocks affect the firms themselves is not very well understood. There is little literature on that, and the literature finds mixed results. Okay, and then again, we focus on firms. If there is uncertainty, what can firms do to attenuate the effects of uncertainty? So basically, there is some literature that found that firms that have some attractive traits like political connection, they suffer less when uncertainty hits. They're not quite affected by uncertainty. They're somehow immune to uncertainty. But then there is no paper, to the best of our knowledge, that studied whether in the presence of uncertainty, firms tend to develop these traits which help them to become immune to uncertainty. So, to the best of our knowledge, no paper has done this. Some papers that found that political connections help firms when there is uncertainty, they help firms not to suffer too much. But whether in the presence of uncertainty, firms tend to invest in building political connection is not well studied. Okay, so that is the background. So now let's talk about how firm-level uncertainty can be measured. It can be, in much of the literature, it has been measured using the stock market volatility. However, there are issues with that, and it can be endogenous, and then stock market volatility picks up all the uncertainty, including like the kind of predicted uncertainty and unpredicted uncertainty. So when we want to talk about how uncertainty affects companies, we don't want to focus on kind of predicted uncertainty. So like variation in stock returns or prices that is predicted, we don't really care about that. We would like to look at unpredicted component, uncertainty that you don't predict, that hits you, how do you behave? We're interested in that. But if we just use stock market volatility, that encompasses both predicted and unpredicted components. So it's not very good. And also it can be endogenous. And also, for example, if you look at the Chinese case, you cannot really look at stock market volatility because basically there are some daily price limits. The stock prices cannot move more than 10% up or down. So stock market volatility is constrained by some government regulation. So in the case of China, it is not ideal. How else have people measured uncertainty? Well, many people have used survey data. So, for example, some papers on Germany have used survey data, but these are very difficult to obtain. You need to make appropriate survey, then companies may not answer, everybody may interpret in a different way. It's kind of quite painful. And because we focus on China, there is no survey-based database that measures the uncertainty at the firm level in China, so we cannot use that. Now, what about dictionary-based indices? There are quite a few papers that used a dictionary. So, for example, they have looked at the reports from the management of the company, the management and development analysis in the firm's annual reports, and they have made a dictionary containing words like uncertain, uncertainty, and stuff like that. And then they have kind of checked whether in this company reports, these words, uncertain, uncertainty, and so on, they appear often or not. But again, there is a problem with this because it's the company can express uncertainty even though it doesn't use like the word uncertain. So it can say, for example, if it says in a report that our company's performance has fluctuated considerably in the last 6 months, that is an indication that maybe there is uncertainty. If the performance is not stable, there is uncertainty, but there is no uncertainty word in this sentence. So, if you use dictionary-based indices, you're likely to underestimate your uncertainty. And you're likely maybe not to identify all types of uncertainty. And also, if you use these dictionary-based indices, then this will be very reliant on the managers, those who write the annual report. It's going to be very much reliant on their language habits. So maybe they're very precise and don't use words which are vague, and that may seem that the company doesn't have uncertainty, but maybe it has. So again, there is a lot of subjectivity in this. So these are like the three standard approaches that have been used to measure the uncertainty at the firm level, but each of them has several problems. So what do we do? Our objective here is, our main contribution is to create this novel firm-level uncertainty index, which is based on the dispersion of news sentiments, and it does not rely on word lists. And so I'm going to explain this in detail in a moment. So first contribution is the development of this novel measure of uncertainty, which somehow helps us overcome the weaknesses of the other indices, which I mentioned before and that have been widely used in the literature. What else do we do? Then we use this index and we look at how it affects how this firm level uncertainty measured using our new index. We're going to look at how it affects two types of investment in fixed capital and investment in innovation, and how it affects relationship building. I'm going to explain how we measure relationship building in a second. And then we're going to find some relationship between uncertainty and this kind of investment. And we are going to study why there is such a relationship. What are the possible mechanisms underpinning this relationship? And we're going to focus on irreversibility and financial constraints as two possible mechanisms. And then when we look at relationship building and how uncertainty affects relationship building, we're going to look at the effects of the COVID-19 pandemic. Why? Well, because relationship building is about interacting with other people, other agents. But if there is a pandemic and then you're not allowed to meet people, there is social distancing and stuff like that, then it becomes more difficult to establish new relationships. So we're going to study that, and that will allow us to make our identification sharper. I'm going to explain it in a moment. So basically, what is the contribution? Okay, first is this new measure of firm level uncertainty, which is forward-looking, which is direct, and it is perceived by individuals. So by using our new method, the new index for firm level uncertainty, we can avoid avoid taking into account predicted components of like stock price returns and stuff like that. So we're going to have basically unpredictable uncertainty. Okay, and then our measure does not depend on word lists, and it can capture a wide range of uncertainties faced by the firm. So it's quite broad. And then in terms of looking at uncertainty and investment, we are like the first to look at both how this firm level uncertainty affects not only investment in fixed capital, but also investment in R&D at the same time using same data set. And then we explore this mechanism, which are investment in irreversibility and financial constraints. And then also, for the first time, we're going to investigate how firm level uncertainty affects the Chinese firms' entertainment and travel expenditures, which are typically used as a proxy for relationship building. I'm going to explain why in a second. And so in this way, we complement some literature that showed that in the presence of uncertainty in other countries, firms try to expand relationships that they have with the political relationship that they have. They try to expand them to encompass new partners. Okay, and then also some other guys have looked at how uncertainty affects the fraction of sales that goes to the government, which can be seen as a way to make the government happy. But we're going to look at how uncertainty affects a different element, which is also related to political connection. But we're going to focus on this entertainment and travel expenditures. And then we're going to look, we're going to add to the literature on the effects of the COVID-19 pandemic. And how do we do this? Well, we're looking for the first time at whether the COVID-19 pandemic affected the impact of uncertainty on firm behavior. So to the best of our knowledge, nobody has looked at how the COVID-19 pandemic affects the relationship between uncertainty and firm behavior. And we do that for the first time. So these are our main objectives and contributions. Okay, so now I'm going to talk a little bit about our data sources. So the data set for the firms that we use is the SISMAR database, so it has like all these companies' balance sheet, profit and loss accounts, and so on. So it's very detailed. And then this SISMAR database also has a database made up of news articles at the firm level. And these articles are provided in the dataset, and they come from 10 million daily news from various news sources, newspaper, online platforms, and whatever. So it's a very rich data set about the news articles relative to the firms that are in our data set. So you can link the news and the firms using the ID. So that's quite convenient. So it has access to 10 million daily news. It's quite a lot. And then for COVID-19, we collect the data from SINA News. So we start with a raw data set made up of 103,000 firm quarter observations. So we look at the analysis is done not at the annual level. The main analysis is done at the quarterly level. And then we have about 5,571 companies. The period that we look at is 2018 to 2023. And then we do a lot of sample selection and data cleaning and things like that. We end up with about 71,540 firm quarter observations. So this is our data sources. Now we come to the juicy part, which is about this firm level uncertainty. So we're going to use the textual analysis to derive it, and basically this index is a dispersion index. So it allows, by using this method, we are able to construct this measure of uncertainty at the firm level, which is forward-looking and which is direct, and which is it comes from the news, so it comes from individuals. Okay, so I said that there are many news at the daily level for each firm. But in addition to having the actual news, we also have, for each piece of news, we have the emotional level, which is basically the sentiment. So we know whether the sentiment is like relatively optimistic or relatively more pessimistic. And things like, oops, sorry, I'm making a mess. And so it tells us whether the sentiment is optimistic, neutral, or pessimistic. Okay, and then what we do, we match this news data set to our listed firm over the sample period. Okay, so each news article has the ID of the firm, and we can link the article to the firm. And then for each firm I, during the time t, the quarter t, we get this, we call it the flu index. So it is the firm level uncertainty index. And it basically, it is based on the dispersion of news sentiment. So it is given by the minimum of the optimistic news for firm I at time t and the pessimistic news, so the smallest one, divided by the total number of news for firm I at time t. Now, what does that mean? Suppose a firm is a very good firm, like very solid firm, the best firm in China. And all the news about that firm, because it's so solid, it's so good, it's such a great firm, all the news will be very positive. So basically, all the news of the firm will be optimistic. There will be basically there will be no pessimistic news. So in that case, the minimum between number of optimistic and number of pessimistic news basically will be 0, because there is no pessimistic news. So if this flu index is 0, it means there is no uncertainty. The firm is always good. The total number of news is optimistic. So basically, that's what we're going to that is what we're going to have. On the other hand, if a firm is not that, we don't know whether it's good or bad. Even the journalists, they get some positive feedback about this firm, but they also get some negative feedback about this firm. Then what is going to happen? Then basically there's going to be maybe half the article at time t for firm I is going to be optimistic, and half the articles is going to be pessimistic. So in this case, basically half of the news of the firm is going to be optimistic, half of the news is going to be pessimistic. So the index is going to be 0.5, basically. Okay, so for a firm that is very uncertain, the most uncertain possible, then we're going to have basically half the news one way, half the news the other way, and so the index is going to be 0.5. But if a firm is always very bad, for example, look at the opposite case, then there are going to be no optimistic news, and there are going to be no optimistic news. All the news of the firm are going to be pessimistic. So optimistic is 0, pessimistic is 100%, and so the minimum value in the numerator is going to be 0. Okay, so for a firm that has no uncertainty, then the index is 0. And for a firm that has a lot of uncertainty, the most uncertainty possible, the index is going to be 0.5. Okay, so where does this index come from? So we didn't, we're the first to apply it to the firm level, but this kind of index was proposed by Schwartz and Son in 2023 to measure the uncertainty of investors' beliefs on the fund manager's skills. So they looked at minimum inflows and outflows out of a fund, and in that case, according to the size of the index, they were able to derive whether the fund managers were skilled or not. So it was a completely different topic. They used a similar index, and we applied to the firm level for the first time. So again, for a firm that has no uncertainty, is going to be 0. For the firm that has a lot of uncertainty, is going to be 0.5. Okay? Are there any questions? This is kind of the key index, so it's important to get this clear.
Yeah. So, Alessandra, is the index already available in the data set, or did you construct the index by yourself?
Yeah, thank you for the question. We constructed because we have the news. For each firm, we have all the news. And in addition to having the news themselves, it says, for every piece of news, we know if the news is relatively optimistic, neutral, or relatively pessimistic. And so in this way, for each news, at time t, we have many news for firm I, and we know whether first news is optimistic, second news is pessimistic, and we can count them. So so we had to put together the news with the companies, basically. Yeah. So that was our job.
I saw some hands. I saw some, but so we need probably more information about how you constructed this, given that you are facing a significant, huge amount of news articles. How did you construct, by using which program? I guess is you have to probably use some large language models program, or how did you do that? And then how did you match your constructed index with the financial and statement data? So, but Alessandra, can we collect a couple of questions before you continue? I see some hands here. I see Yusuf is the first one, and then Tendai, and then Kiri. Please, yeah. Yusuf. We cannot hear you.
Yeah.
Okay.
Can you hear me?
Yeah, now we can hear you. Yes.
Okay, good. Yeah. Okay. I Alessandra,
Hi.
Nice to see you. Really interesting. Yeah, just quick question. Basically, Alessandra, are you looking at also the information coming at the industrial level? Because if I'm informed in some industry, even if the news does not mention explicitly my name, but it can create also some kind of uncertainty at the firm level. Have you looked at that as well? Yeah.
And then we are collecting the second question, or maybe the third one. And Tendai?
Thank you for the presentation. Very interesting. My question is whether you give equal weights to the different pessimistic events. I'm thinking perhaps news around COVID is more devastating, but maybe a minor strike by very few workers within the industry or affecting the firm, perhaps not so devastating? Do you give equal weight to such pessimistic events? Thanks.
Okay, thank you. So, Kieran, please.
Yes, thanks very much for something really very interesting so far, Andrea. First of all, I wonder what the time scale of this uncertainty would be. Would it be short term or long term? And secondly, the Baker-Bloom kind of indexes have been used for a long time, but I haven't seen much in the way of comparisons to how they fare in comparison with other more standard things. I mean, you mentioned a number of the possibilities, but there's also gauge of sales, which is often used as an indicator of uncertainty, which can be used at firm level. And finally, I was just thinking of it in terms of, say, if we were to construct that index in relation to the US at the moment, for example, in the AI tech industries. So you might find, because I imagine that the optimistic pessimistic relates to the stock market performance rather than the real economy in terms of these firms. I imagine the majority of commentators would be about that. So probably if you were looking at that industry in the US, you'd probably get a predominance of people being optimistic about it. But at the same time, if you read the opinion, the heavyweight opinions in places like the FT or the Wall Street Journal, you'll get an underlying rumble of discontent about whether this is sustainable and so on that might not be picked up by the balance of the index. I'm just wondering about that. So thanks.
Yeah, so I have to add, Karen has done quite a lot of work on investment and uncertainty as well, irreversibility, real options. So I started with Karen at SOAS actually for some papers. So yes, so that's why we have a lot of questions now. Alessandra, I think it's good to be interactive when we have some questions. So the floor is yours, Alessandra, if you want to respond, just pick, yeah.
I will respond to a couple and then I will pass on to Dongqiang. So be ready to answer to some questions. Okay, so the first one is for the ID of the firm. Each news is related to the firm ID. I mean, it's related to a firm and it has the firm ID. So we can link the news piece of news to the firm very easily through the ID because they have the same ID. So that's to answer your question, Hong. About the method that we use, I will pass on to Dongqiang in a moment. In terms of industrial level information, I think this news that we have are relative to the firm, but I think that if there is some like crisis in an industry, for example, I think that would be picked up in the news that are relating to the firms in that industry. But again, Dongqiang may want to add something in a moment. Equal weight to all events. I mean, some pessimistic news can be like very, very bad. I don't know, maybe if there is some crisis and some very bad news, maybe there is going to be more news on that event, maybe. So it would have more weight because it has more news. Yeah. And in terms of other, like, okay, we compared this method to the dictionary-based method. So we tried to use a dictionary-based method as was done in the literature, but then we showed that this underestimated the uncertainty quite a lot. So we showed in the appendix that it's not a very good method. We didn't compare to other methods like the gauge method, but maybe we can do that later. And whether it's a short or long-term uncertainty, yeah, that I don't know. It will depend on the news, but maybe Dongqiang can add something to this. So, so maybe.
Okay.
Yeah.
Okay. So, can you hear me?
Sorry, yeah. I did not introduce you. Can you introduce yourself a little bit to let us know how you are doing? Yeah.
Okay, and yeah, I'm a final year PhD student in the University of Birmingham, and Professor Alessandra is my first supervisor, and I will be submit my thesis last week, and the Viva will be held in the mid of the October this month, and my field is on the corporate finance, mainly on the corporate finance, and and such as like the firm's financial constraints, green innovations, and investments and uncertainty. Yes.
Great.
Okay.
Yeah.
Okay. So as for the questions, well, the first question is about like the industry's news. Is that like yes, we didn't include it because we only focus on the news that targeted on the specific firms, but not like all the news in the economics, including like, for example, there are some news about the industry policies, or there are some news about other type of the economic factor, but not targeted on a specific firms. But if there are but because we know that this news will be also like the firm's news will also mentions such time of the crisis or the industry shock and so on. They are all included in the news articles. So that is the first questions. And the second question is, I agree with Professor Alessandra's point is that if there are some crises or there are some shock, for example, there are some events that are more important to the firms, and then like the analysts or the journalists, they will mention many times for the firms, but not just one. So I don't think, I think actually there is a weighted average, but not just a equal weight, because like the journalists will, because for those more popular events or for those events that are more important to the firms, they will, we will have more news articles to the firms at that time. Yes, and for the last, for the questions about the short terms and the long terms, yes, actually we can change the time period, the sample periods or the time range of our index, and then we can, for example, we can construct those the daily uncertainty, the monthly uncertainty, or weekly uncertainty, and the yearly uncertainty. So I think this index can captures either the short terms and the long terms uncertainty, but that's an average one. And as for the comparisons to the others method, for example, using the AI, yes, and well, I think the most the advantage for this index is we combine the many opinions from like 10 million news articles, and we can also try to use the AI, for example, the LLM models to identify like the uncertainty level for each articles and then make a weighted average. Or we can, because now we identify the news sentiments, and based on the database, they already use some AI methods to identify the sentiments degree for each news. But we can directly to capture those uncertainty for each news articles and then make an average. And yeah, because well, compared with those methods, just focusing on the firm's annual report or the semi-annual report, or just focus on some Wall Street news articles, like our methods is can be seen as a average opinions on to the society that combines many parties outside, maybe outside the event, the specialists, but just focusing on all the investor. So that is the advantage. Yes.
Yeah. And maybe just one more. So Alexandra said that this the index of your uncertainty is forward-looking.
Yeah.
Why is that forward-looking? I cannot really see the forward-looking content here, because everything is published, right? It's from the journal, from the news articles. How do you distinguish between the reports of something that happened already that they reported, and how do you get that forward-looking thing?
Yes, and as for the forward-looking strength for the indexes, like because this time of the text, like I try to collect a small samples of the articles and to see what contents they included in their samples, and most of them they will not just evaluate for example, as for the performance, because well, in the unreported result, we try to classify the news article into different topics using the LDA methods. And we try to focus on, for example, the firm's performance. And actually, the news articles most of the news articles are about are not evaluating their past performance, but focus on what their performance will change in the future. So I think that is what time of the forward-looking change for the index. Yes.
Okay, so yeah, well, I take it partially, but yeah, I can imagine some journal articles on Alibaba, for example. It has to be something that they reported that is about what has happened. And but if you can filter, the reports that about the prediction, and that will be very nice, because uncertainty is all about the future. It's not about the past. So, and that's why textile analysis probably can produce something new, which is closer to the emotion, to the subjective things of the decision makers. So I see a hand from Ali. Ali, could you come please?
Hi,
here?
sorry, just a quick question. When you matched it to your firms for these articles, didn't you find that most of these articles would relate to large size or mid-size firms? The small cap firms would have very little articles. Was it equally balanced, or was it skewed towards the large cap firms? Because I'm assuming the informativeness would be much lower for small cap firms, so they should have less articles, and large cap firms might have more articles. Or was it balanced? Just to inform myself on this.
Yes, that is a very good question, because we also received a comments before in the seminars, and they also criticize that for some small firms, they may have not enough the news articles about the small firms. So we set up a threshold and delete those firms, those samples with small numbers of the news articles. Yeah, and to try to eliminate these concerns. Yeah.
All right. Okay.
Thank you. So we are.
Thank you.
Sorry, who is? So let's round up this round of Q&A. So we will have probably another round, and we still need to hear what the paper is about. So Alessandra, could you please continue?
Okay. Yeah, thank you very much. Yeah, thank you for the very useful questions. And yeah, so this is our index. And then this is just to show you the behavior of the index. And of course, during the period, the pandemic period, you can see that it goes up quite a lot. So clearly there was more uncertainty for everybody, firms included, during the pandemic period. And it's always very, very high until 2023. So, and it's also like in other periods, it fluctuates quite significantly. So that's just to give you an idea. Okay, now we're still talking about our data. How do we measure the relationship building? Okay, so in China, there is kind of the tendency for firms to build social networks and relationships with other parties like the government or the banks or executive at other firms. That is called Guariglia in China. And it's basically a very popular strategy for companies in China. And why do people do this? So, for example, why do companies do this? For example, companies want to establish relationships with the government, say the provincial government or the central government or local government or whatever, because that will help them getting some governmental contracts, or it will make it easier for firms to get loans from the banks. It will make it easier to have tax incentives, or, if the firm has some political connection with some provincial government, for example, it may be exempt from some problematic laws and regulations. So this kind of Guariglia is very, very important in China, and it helps firms do business. Okay, so we are going to follow several papers in the literature, and in order to measure this relationship establishment, we are going to look at firms' spending and on entertainment and travel expenditures. So why do we do this? Well, because if a firm wants to establish a relationship, say, with the provincial government, it will invite, say, the government official for a fancy dinner so they can get to know each other. Then comes like some festival. It will, provide some gifts to the government official. And then, if we want to develop the relationship even deeper, then the company may kind of pay for some travel expenditures for the government official to go to Hawaii and stay in a 5-star hotel and stuff like that. So how do they pay for this? Well, in the balance sheet, there is this item for entertainment and travel expenditure, which basically it's a kitchen sink. It includes everything. So it will have a component which will have like legal expenditures for, travel. Say when the CEO has to visit some, other provinces to establish some business relationships, they will have to travel there. That's a legitimate travel, but it will also include like travel when they want to pay the provincial governor some fancy holiday in Hawaii or stuff like that. So it includes a bit of everything. And this entertainment and travel costs, they provide kind of a way to kind of hide some corrupt activities, because this guanxi, if it's pushed to the limit, it is borderline to corruption. I mean, basically, if you pay all these things to the government officials just to get more bank loans or tax holidays or exemptions from regulations, then that is very close to corruption. And so the companies pay for these activities through this ETC, entertainment and travel costs. Again, there is a huge literature that has used it, so we follow that literature. I'm going to explain in a moment how we differentiate between the legal, legitimate, and corruption part of this ETC. So, as I said before, if the CEO has to visit some other provinces to establish business relationships with other firms, then he has to travel there, and then that is going to be a legitimate business. So we have ETC, which is the total, and we're going to regress the ETC on several controlled variables like the size of the firm, the age, and executive compensation, and things like that. And then we are going to take the residual as the abnormal ETC, basically. So the fitted value of this regression model can give you the legitimate entertainment and travel costs, those that are, you have to incur this to have to do business properly. The residual is the kind of abnormal entertainment and travel costs. So in this way, we can differentiate from this kitchen sink, which is ETC, we differentiate the legitimate component and the abnormal component. So in our regression models, we are going to show both the total and the abnormal component, just in case. So again, this is not some invention of ours. There is some papers published in top finance journals that use this method. Okay, now let's move on to what do we find. Okay, so the first part, we're going to look at investment actually in fixed capital and research and development, and we're going to see how our firm level uncertainty index, the FLU index, affects investment. Okay, and then investment can be first fixed asset investment and then R&D, is investment in R&D. And then the second equation in this slide is about the relationship building. And again, we use the total entertainment and travel cost, but we also use the abnormal, the residuals of that model I had in the previous slide, just to pick up the more kind of close to corruption part of this ETC. Control variables, I'm not going to spend too much time on it, but they're standard from the literature. We use the fixed effect model in estimation, so VI is a fixed effect component, so we can deal with the unobserved heterogeneity. Now, let's move on to some results here. So again, there are a lot of control variables. I'm not talking about them in the interest of time. Their signs are consistent with the literature, so they give credibility to our estimations, but they're not on the slide. So in this table, we have the results for column 1, the fixed investment, column 2, R&D investment, column 3 is entertainment and travel cost, and then number 4 is the abnormal entertainment and travel costs. And we can see that for both types of investments, we have negative coefficients on the firm level uncertainty. So it looks as though the higher the uncertainty that the firm faces, the lower will be the investment in both fixed capital and R&D. By contrast, the higher the uncertainty that you face, it looks as though you're going to want to spend more in entertainment and travel, which is likely to be done in order to establish more relationships, which may allow you to have more political connections, which allow you to kind of face the uncertainty in a better way. So What about economic significance? So if we take a firm and it moves from, say, having uncertainty, having the flu index equal to 0 to having a flu index equal to 0.5, that means a firm that moves from having basically no uncertainty at all to maximum uncertainty. What happens to its investment? Well, it's going to show an investment in fixed assets which will be 5% lower, and so the firm that has no uncertainty, that moves to maximum uncertainty, R&D investment will be 4% lower. What about relationship spending? That will become 4% higher. So the firm will show much lower investment in, if the uncertainty becomes high from low to high, the firm will show much lower investment in fixed assets, much lower investment in R&D, but it will show a much higher expenditure on travel costs, travel and entertainment costs, possibly aimed at establishing the political connections. Now, this analysis, as I said before, it is done based on the quarterly data. Now, if we replicate the analysis on annual data, the effects are even bigger. They nearly double if we move on to using annual instead of quarterly data. So that is quite interesting. Okay, and then we do some robustness tests. Okay, so our firm level uncertainty somehow may be driven by some firm invariant characteristic like industrial or provincial factors. So we follow some literature and we devise a new measure of firm level uncertainty, which is going to be the obtained by regressing our original index on a battery of fixed effect like industry, provincial, fixed effect, and so on, and taking the residual as our new firm level uncertainty. So in this way, we purge our firm level uncertainty index of these parts of uncertainty which may be due to industrial or provincial factors. And that's one thing that we do. And then also, this entertainment and travel cost, it's not available for all the firm quarter observations that we have. So not everybody reports it. So the regressions that we have for ETC are based on a smaller sample. So we try a robustness test. We use so-called business entertainment expenditure, BE, which is available for more observations. But this is not ideal in our opinion because this BE also includes administrative expenditures, which may not be aimed at establishing new relationships. So it is likely to overestimate the relationship building expenditure because it contains a big chunk, which is administrative expenditures, which are not related to relationship building at all. But we still use it as a robustness test. So what do we get? Flu alter is the alternative measure of firm level uncertainty. And it is basically, the results are still very similar. You can see that the coefficients associated with fixed investment and R&D investment in panel A, columns 1 and 2 are still negative and significant. And the coefficient associated with ETC and abnormal ETC, they're still positive and significant, columns 3 and 4. And then we go back to the original flu index, and in panel B, we have this business entertainment expenditure and abnormal BE. And the results, again, are similar. But you can see that they're similar to column 3 and 4 in panel A. But you can see that the number of observations in panel B is much bigger. You see in panel A, columns 3 and 4, where we use ATC, the number of observations is basically half of what it is for the first 2 columns of panel A. But in panel B, we have much bigger number of observations. So we think this robustness test is quite interesting, although may overestimate somehow the relationship building expenditures. Okay, so now we found that this firm level uncertainty, regardless of how we measure it, is negatively associated with investment of companies in both fixed investment and R&D investment. So we want to see why is that? What are possible channels that can explain this negative relationship between firm level uncertainty and investment in fixed capital or R&D? So the first reason proposed by the real option theory was investment irreversibility. So basically, if investment is irreversible, once you invest, it's very expensive to divest. So if you have uncertainty, you're going to wait before investing. You want to be sure that this investment project is good and that you will be able to profit from this new investment project. So if there is uncertainty, you wait and see. You wait and see in order to evaluate the long-run returns. And only if the long-run returns are good, you invest, because otherwise it's going to be too risky. So investment irreversibility is a possible channel that can explain why in the presence of uncertainty you invest less, you wait and see. Another possibility is financing constraints. So according to net present theory, a firm will kind of delay or just halt some investment projects if the expected return rate of an investment is smaller than the cost of financing this investment project. So if the expected return rate is too low compared to the money you need to pay to finance the investment, you prefer to wait and not invest. Okay. Now, in the presence of uncertainty, then we don't know whether the firm will go bankrupt and so on. So the bank is likely to charge more money to the firm in order to give the firm a loan in the presence of uncertainty, because uncertainty means that the firm may die, and so the bank wants to be kind of sure, so it's going to charge higher interest rates. And so if there is uncertainty, it's likely that the firm will have to pay higher cost to get the loan from bank to finance its investment. And so it will want to wait, delay its investment until it has enough money to fund this project. And in order to be sure that the expected return of this investment project is going to be high enough to justify the project, even though the cost of financing it is higher. So financial constraint can be another possible channel explaining why in the presence of uncertainty, the firm will invest less, because there is going to be more financial constraints, and the firm will face higher costs to finance the investment, and it may want to wait to make sure that, in fact, the expected return will be high enough to justify this investment. Until the company is sure about this, or until it accumulates enough funds to pay for this increased cost of bank loans, then it will just wait and see. So we're going to test these channels in turn. Okay, so let's start with investment irreversibility. Now, we follow the literature and we calculate irreversibility at the industrial level. So we calculate a reversibility score across industries. Basically, if you look at an asset, if a given asset is used very frequently as an intermediate input in other industries, so this asset is used by many industries as an intermediate input, you can see that the asset is quite reversible. But if the asset is only used by one or two industries, then it's only valuable to those industries and it is not very reversible. Okay? So that is for fixed assets. And we're going to calculate this reversibility score at the industrial level. Okay? So a firm that has a low reversibility score will be characterized by irreversibility. So if this firm has assets which are mainly used very rarely as intermediate inputs by other industries, then this firm will be facing irreversibility problems. So that's at the industry level. What about research and development? Again, we follow some literature and we look at the industry level R&D intensity. So at the industry level, we look at R&D expenditure over sales. And that is going to be the proxy for innovation investment irreversibility. Why? Well, an industry which has high R&D intensity will have faced a lot of very high intangible sunk costs, okay, and it will also face a higher likelihood of market failure. And also R&D assets, they're typically very specialized. Specialized knowledge or proprietary technology. So R&D assets like this are very specialized and difficult to reallocate. So they're beneficial to this particular industry, but maybe not for others. So this justifies why this very high intangible sunk cost and greater likelihood of market failure, and the fact that these R&D assets are very specialized, they can only be used in a few industries, justifies the use of high industry level R&D intensity as a measure of R&D irreversibility. So these are the two ways in which we measure irreversibility. And what do we find? Now, here are the results. We have fixed investment, column 1 and 2 of this table, R&D investment, columns 3 and 4 of this table. And then we divide the sample according to whether the firm operates in an industry characterized by irreversibility, which is higher or lower than the median. And so if it's irreversibility equals 1, the firm is located in an industry characterized by investment irreversibility. Otherwise, irreversibility is 0, and the same for R&D. And you can see that this firm level uncertainty coefficient is negative and significant, but only for those firms characterized, for those firms that operate in an industry characterized by irreversibility. And we did a t-test to see whether the coefficient on the firm level uncertainty in columns 1 and 2 on the one hand, and columns 3 and 4 on the other hand, whether the difference in these two coefficients is statistically significant, and we found that it is statistically significant. So the negative effect of the firm level uncertainty on the investment in both fixed asset and R&D seems to appear only for firms that operate in irreversible industries. And so this is consistent with the real option theory from Bernanke in 1983. So it looks as though that relationship that we found, negative relationship between firm level uncertainty and investment that we found in the full sample, is driven by firms operating in industries characterized by irreversibility. Okay, what about financial constraints? Now, we measure financial constraints using the Kaplan and Zingales index. So this is an index which was devised for the US, and it's an index which is based on some firm-level accounting ratios, and basically it was devised for the US, but there is a version that is applicable to the Chinese context, and basically this KZ index applicable to the Chinese context, we don't have to calculate it by ourselves. It is available in the SISMAR dataset. So we divide, using this KZ index, we create a dummy variable, which is a financing constraint variable, equals to 1 if the firm's adjusted KZ index is greater than the median at the industry level in a given year, and 0 otherwise. So we construct this index, and we then estimate our model for the companies that are financially constrained. So FinCon equals 1 for the financially constrained companies, and FinCon equals 0 if they're not financially constrained using this index. And then you can see column 1 and 2, we have fixed investment, and we can see that the coefficient associated with the firm level uncertainty is only significant in column 2 for the constrained firms, and then in column 4 for R&D, again it's significant. In columns 1 and 3, the coefficient on the firm level uncertainty is not significant, and the differences in the coefficient associated with uncertainty in column 1 and 2 as a t-test is significant, showing that the difference is statistically significant. For R&D, it's kind of not really significant, but still. We can conclude that overall these results are quite consistent with the net present value theory, and that because we can see that the negative impact of the firm level uncertainty on these two types of investment only prevails for the constrained firms. And if you don't like the KZ index, there is a huge literature that posits that the smaller firms are more likely to be financially constrained. So we calculated the financial constraint index based on size, and we obtained results which are similar to these ones. So basically, we can conclude here that in addition to the investment irreversibility, financial constraints can be another mechanism underpinning the association that we found in the full sample between our firm level uncertainty and these two types of investment. Okay. So I don't know if there are any questions now before I talk about the pandemic, maybe because then it's a different part of the paper.
Alessandra, we can go ahead with this COVID,
okay.
And then we collect some more questions,
fine.
please.
Perfect.
Thank you.
Yeah, thank you.
Mm.
Yeah. Okay, so then what we want to do is we want to see what happened to this association between firm level uncertainty and investment on the one hand, and between firm level uncertainty and relationship building on the other hand, what happened during the pandemic. Okay, so the pandemic can be seen as an exogenous shock that has restricted the firm's activities in relationship building, because if you have to stay inside, you're not allowed to meet people, you cannot have these dinners to invite government officials and establish some relationships with them. So we think that there could be a problem in using relationship building as a tool to make the effects of uncertainty on investment smaller. There could be a problem with this during the pandemic. So although firms may want to increase spending on relationship building during the pandemic when there is uncertainty, in order to reduce this negative impact of uncertainty, the pandemic was a period characterized by huge uncertainty. So firms may have wanted to establish a relationship with government officials, for example, to mitigate the effects of uncertainty. However, if relationship building was limited by the pandemic, so there were social restriction policies. You had to stay at home. You couldn't have these dinners at all. The restaurants were closed. You were not allowed to have any meeting whatsoever. Okay? So here we have some kind of graph which shows the monthly trends of confirmed cases in different provinces in China. So as you know, during the pandemic, the social restrictions policies in China were very strict, much stricter than in the UK or the US. So very, very strict. And so this meant that the confirmed cases remained quite low during the period 2020 to 2022. You can see some big spikes in 2023. That's when the zero COVID policy was released. But during period in which COVID was very bad in the UK or the US or Europe, in China, it was quite under control. There were fewer confirmed cases. So what we're going to do is we're going to look at how the pandemic affected the results that we explained in the previous part of this seminar. We're going to do this in two ways. So we have to differentiate the pandemic period from the non-pandemic period. So first is obvious way. The pandemic period is the period from first quarter of 2020 to fourth quarter of 2022. So this is kind of the pandemic period in China. Other periods from 2018, 19, and after 2023, those periods are non-pandemic periods. So we have a dummy variable, pandemic 0 and pandemic 1, okay? However, that's maybe not a good way to measure how the pandemic affected, especially relationship building, because if a province didn't have any confirmed cases, then there was no social distancing. You had to wear a mask, but you could still go to a restaurant and host people and have whatever. So you could still engage in relationship building in a province if there were no confirmed cases. However, if in that province then the confirmed cases, some confirmed cases appeared, then it was locked out completely. Okay, but if this didn't happen, then relationship building and entertainment was allowed. So only looking at pandemic period 2020 to 2022 is not very good because even during that period, if your province didn't have confirmed cases, you could engage in relationship building. Okay, and then also looking at pandemic period 0 or 1 doesn't allow you to account for the heterogeneity across provinces. So we use another pandemic indicator, which is the following. We divide the sample based on the presence of newly confirmed COVID cases in the location where the firm is. So we have confirmed cases, yes or no. If confirmed cases is 0, there is no confirmed case, you can still go to dinner, invite government officials, have dinner and whatever you want. If there are confirmed cases, then everything locks down, no dinners, no entertainment, no relationship building. And that kind of, even during the period 2020-2022, some provinces were affected by the social distances, some provinces were not. So the second way to look at the effect of the pandemic allows to take into account this provincial level heterogeneity. Okay, now what do we see? So here we have for results for fixed investment and then for R&D investment. So pandemic 0, pandemic 1, pandemic 0 is 2018-19 and then after 2023, and pandemic 1 is during the actual 2020-2022 period, we can see that the firm level uncertainty has a negative effect in both cases, but it is much bigger in column 2 during the pandemic. If we measure the pandemic by the presence or absence of confirmed cases, column 3, okay, there are no confirmed cases, pandemic uncertainty has a negative coefficient, but it's only marginally significant and quite small. If confirmed cases is 1, then a lot of social distancing and stuff like that, you cannot do any social relationship building, and so your investment suffers more. If relationship building allows you to mitigate the effects of uncertainty, in column 4 you have no social interactions, no relationship building. That explains why the coefficient in column 4 is highly significant, much bigger than the coefficients in column 3. What about R&D? Well, again, you see the same in columns 5 and 6 and 7, pandemic 0, so outside of the pandemic, and no confirmed cases. The firm level uncertainty has no significant effect on R&D investment. However, in the pandemic period or in the presence of confirmed cases, negative effect of the uncertainty on R&D investment, negative and highly significant. So during the pandemic period, firms facing uncertainty or firm located, or during the pandemic period, or if you are located in a province with new COVID cases, uncertainty leads to a reduced investment, okay? So in terms of fixed investment, even outside the pandemic, you have a negative effect of uncertainty, but it is marginally significant and much smaller. During the pandemic, the effects of uncertainty on investment are much, much, much larger. And we say, why? Well, we claim this is because firms could not rely on relationship building due to social distancing. That is our claim. But is that true or not? Let's see. So here we got our entertainment and travel cost. This is our proxy for relationship building. And we have our abnormal ETC. So what can we see? In columns 1 and 2, we can see that outside of the pandemic, the relationship building coefficient is much bigger than in column 2. Okay, 0.046 is much bigger and highly significant. In column 2, during the pandemic, the same coefficient is much smaller and only marginally significant. If we measure pandemic with confirmed cases, if there are no confirmed cases, uncertainty has a positive and significant coefficient on ETC. If there are confirmed cases, it's not significant. So that tells us that if there are confirmed cases, there are a lot of social restrictions you cannot entertain, and so you cannot rely on ETC at all. If you look at abnormal ETC, columns 5, 6, 7, and 8, you can see that the coefficient on uncertainty is only significant outside of the pandemic, only significant if the pandemic, if there are no confirmed cases. Inside the pandemic period, and if you have some confirmed cases, then uncertainty has no effect whatsoever on abnormal ETC. So we can see that firms that face uncertainty, if they happen to be during the pandemic period or if they are located in province with new confirmed cases, then they cannot spend more on relationship building. And that explains why, for these firms, the effect of uncertainty on investment was much larger. And that is our conclusion here. So the fact that during the pandemic, and if you are based in a province with new COVID cases, you cannot spend more on relationship building. As a result, this uncertainty is going to affect your investment a lot more because you don't have this cushion, which is the relationship building, which may, in normal times, might help you mitigate the effects of uncertainty on investment. Okay, in the COVID period, if you are in the provinces with social distancing measures which are active, you cannot use this cushion, you cannot use this relationship building. Hence, the uncertainty leads to a much stronger decline in investment. So that is our main story. So let me just provide some summary. So we create a new index for firm level uncertainty, and this index is based on the dispersion of news sentiments. And we find that it is negatively related with investment both in fixed capital and R&D, but it is also positively related with spending on relationship building. And then we found that in order to explain the negative association between uncertainty and investment, we found that irreversibility and financial constraints are two possible channels. And then we found that due to the very strong social restrictions that were put into place in the pandemic, spending on the relationship building was not very effective. And then as a result, firms facing uncertainty had a much stronger negative effect on their investment because they couldn't use this relationship building as a cushion. And then in terms of policy implication, okay, we find that in normal times, firms spend a lot on relationship building, and this helps them mitigate negative effects of uncertainty on investment. But the spending on relationship building, this very nice dinners and paying very extravagant gifts to government officials and stuff like that, is maybe in the presence of uncertainty is not a very good strategy. It's money which is somehow wasted. But we found that the relationship between uncertainty and investment is partly driven by financial constraints. So in order for firms not to have to incur in this spending in relationship building, the government could simply alleviate some financial constraints for the firms that have good investment projects. So if the firms with good investment projects during uncertainty periods, if these firms could easily access loans from banks, then financial constraints would not be that binding, and then firms would not need to invest in relationship building in the presence of uncertainty, because financial constraints are a very important channel, which explains why uncertainty is negatively associated to investment. If the government were to reduce the financial constraints faced by firms, making it easier for firms to get loans from banks if they have good investment projects, then relationship building would not be so popular, probably. And if uncertainty hits, then the firm would be kind of able to navigate through the winds of uncertainty without the need to use corrupt practices like relationship building. So our policy implications relates to this. And this is the end of the presentation. So thank you very much.
Thanks, Alessandra. I really like the last transparency. And I think I will now collect some questions. I'm sure the second half is very interesting. So we talked about the construction of the uncertainty based on the news articles, and now it's about the relationship building particularly, and more interestingly, I think COVID. So the way that you use this COVID as a structure break, and then to see whether or not the mitigating role of relationship building is changed, by this type of event. So I have some questions, but I want to see more hands. Do we have some questions from colleagues, friends? Why not? Okay, I will kick off the questions focus on the second part, Alexander. First of all, for this COVID thing. And COVID itself is a shock, is a very big shock, negative shock. And so I see that there are some overlapping elements between COVID impacts and the impact of your uncertainty indicator on firm investment and uncertainty, et cetera, et cetera. So, for example, during COVID period, most people probably they stayed at home, so they did not participate some real activities. So therefore, the firm's investment, R&D, etc., they were much lower than normal cases. So are there any overlapping effects here? And you say during COVID, oh gosh, who is there? Can you mute yourself, please? Who is this? Can you mute yourself, please? Yeah, thank you. So during COVID, so you interpret this higher uncertainty effect during the COVID by just focusing on the lack of relationship building activities. So I found this is a little bit difficult for me to completely take in. And for example, everything is digital in China. So during the COVID, I stayed at home for a couple of months. So I had much more time in networking, not really by going to a restaurant or somewhere else, but by maybe texting and discussing conversations, etc., etc. Do you think, is this something that can also help to build up a relationship? Oh, so your assumption is during COVID, if you see the figures, the numbers, the expenditures was much lower. And then you say because they did not go to relationship building. To me, I think probably people had quite a lot of time in everything. You can do everything via WeChat, WhatsApp, and you can do everything by digital payment, probably. So that's my first question. So how are you so sure that this is because of the lack or the decline of relationship building activities? Secondly, my second question is about the impact of uncertainty on firm activities, investment or R&D. In the literature or the theory, sometimes we very often say it can be positive or negative in terms of the impact of uncertainty. So you completely ignored the positive impact. So, and then, okay, you found the negative one, but what do you think about, so why is this negative? Why are the new news articles producing a negative impact on Chinese firms' investment? So that's my two comments or questions.
Okay, yeah, thank you very much. Yeah, it's a very interesting point. Okay, so let me first answer the question on the fact that you can do things online, but you cannot eat online, and most importantly, you cannot drink online. I mean, I remember attending some very fancy dinners when we went to China to establish partnerships with some institutions that we really wanted and stuff, and they wanted us. And we had these dinners which were fantastic, and so much food, so many courses and so many things. I don't personally drink alcohol, but there was that alcohol very strong, and my colleagues like that a lot. And so you drink and you talk, and then you become friends, and that's how it works. So, I mean, I'm happy to have meetings online, but it's not very exciting. If you give me food, I will be very much better disposed than just doing it online. So, yeah, so I think and also traveling was restricted. So like a lot of these companies, they used to pay some travel, very nice travels and hotel stays for these officials and stuff, but then you were not allowed to travel. So, I mean, partly you can do things online, but, that element about, trying to wine and dine relevant people, it doesn't really work. I mean, it can work a little bit, but I don't think it works very much. So, yeah, I mean, it's a little bit difficult. So that's my answer to that question. in terms of COVID and innovation, well, I mean, it is possible that you cannot go to the labs and during COVID, so your innovation will go down because of this. But then also they have like some disruptions in the supply chains and stuff, so they had to find new ways to solve this. So there is some literature that found like positive effects of COVID on innovation and some literature that found negative effects. And so, like, I mean, it's difficult to say which one is right and which one is wrong, but it's like there are elements saying that it's there are some elements which say that COVID was good for innovation and any crisis, because COVID had also like created an economic crisis. And so, for Schumpeter said that crises lead to higher innovation back in 1942. So, that is a positive thing. But then, there are like all these restrictions. You cannot go to labs and things that would mean that COVID has a negative effect on innovation. So it's a mix of both. I mean, it's like difficult to say which one should prevail. In terms of uncertainty, like we found it has a negative effect. And so, the real option theory justifies that, from a theoretical point of view. And again, this irreversibility and the fact that investment is reversible, if you happen to have this uncertainty, then, you want to wait and see. And, and the financial constraints also, we provided that as a mechanism. Of course, during COVID, that became worse because banks didn't loan as much money and it was difficult to find external funding for all the companies. And so the firms would have, facing uncertainty, they would have wanted to wait until they have enough funds to do the investment, to be sure that this is the right investment with sufficient returns. So, I mean, that's the way I would see it. But maybe you're...
fine. So, we see, well, that's why we need the discussion so that we put everything together so people have a wider range of opinions and we understand the issues more. So can we have more questions from the audience? Or do we have? No? Okay. And Alexandra, is your call also? Okay. Oh, Issofu. Hi. Great. You are welcome. Yeah. Thanks for the contribution. Come in, please.
Very interesting. Can you hear me?
Yes, we can hear you.
Yeah. Okay, right. Yeah, Alessandra, thank you very much. A very nice piece of research, actually. Yeah, I know at the beginning you were saying that the volatility actually on the Chinese market is some kind of bias because, it's controlled. Then it cannot go up and down, up on the, above a certain limit. But have you checked, your certainty with even that volatility that is actually controlled, actually? Because I would expect it that if there is too much uncertainty, maybe the volatility will go very high, but up to certain level. If you did any type of correlation between your volatility and the volatility you have, actually, even if it is biased on the market, and that uncertainty, you are getting.
Yeah, thanks for the question. But that limit applied to the stock market, stock price, or stock return volatility as a measure of uncertainty, but we don't use that, in fact. So that price limit doesn't affect our measure because our measure is only based on the news articles. And so it's not based on on how the stock price or stock return behaves. So that was a criticism. At the beginning, I talked about how other people measure this uncertainty. And I said this traditional way of doing it in the Chinese context may be a little bit difficult because of the price limits. But we don't use that at all. So
but I know you are not using it, but the point I'm trying to get is basically if you have that kind of uncertainty, then that should be, also probably get into the price actually. Then we should see that as well in the volatility, right? If there's any impact on the firm, right?
Possible. We didn't check that type of volatility, so we only used our measure. And we also used a dictionary-based measure, but that was, just to show that it was not very reliable. But yeah, so that what happens to the, well, if something crazy happens to the stock prices, it will be picked up by our measure because the articles will discuss it, of course. So so it will be indirectly picked. We don't use that stock price volatility directly, but if there is some big up and down, the articles will discuss it, and so it will be picked up by the news articles that make up our uncertainty measure, I think. Yeah.
Okay, thanks. Yep.
And also, Alessandra, I know I was thinking about your uncertainty measure. You said that you know the sentiments, you know the optimistic view or pessimistic view. So how did we see this in your paper? Did you check this?
Well, yeah, because for every news, we calculate the number of we calculate the number of optimistic news for firm I at a given time t, and then we calculate the number of pessimistic news for firm I at time t, and that was the numerator. The minimum of the two was the numerator of our index. So if a firm is for sure a very good firm, all the news are positive, so pessimistic is 0, so the index is 0. Because
so it is already in the index, right? When you construct the index, it is there already.
Yeah, the number of positive news, pessimistic news, and the number of so that's kind of the the most the most important part of the index. Actually, it's based on the sentiment of each piece of news, how many are positive, how many are negative relative to the total. Yeah.
Okay. Yeah. So the impact, estimate the impact of uncertainty on investment is just the average of, average or the intention of this, opinions,
you calculate and you see the proportion of positive and negatives, and so if a firm is always positive, it will only have optimistic news and 0 pessimistic, so the index is 0. But if a firm is there, some think it's good, some think it's bad, there will be half and half, and so the index will be 0.5, something like that.
Okay. So is your course going to add anything, Dongqiang? Do you have anything to add?
You're still muted.
You're
still muted.
Sorry about that. Yeah. I think the presentation is quite good, and as for your question, I want to add some point. First is about the because we know that the online, the offline, the communications may have possible to build the relationship with other parties. Yes, but we have already found some literatures. They show that the in-person meetings or in-person communication would be more effective than the online one. Yeah, so just
definitely. Yeah. And Jeffrey, do you have a question? I saw your hand. Do you have a question, Jeffrey?
Yes. Thank you, Alessandra, for the presentation, and I find the topic very interesting. I just wanted to add, because I was reading the paper yesterday about how COVID affects business relationship, because when I saw the headline, so I found this paper on Italy, which shows that COVID actually improved relationships among businesses in Italy. So I'm wondering whether it's possible for you to look for a direct measure of relationship instead, because I think that will give you the direct impact. Because I think in that study, they managed to find a way to measure relationship directly rather than expenditure on relationships. So because that's kind of something that I was thinking about, where that is possible. And when Professor Bo made the comment about the possibility of relationship improving because during COVID, we had a lot of software that came along, like these teams that we are using, which made it possible for businesses to come together and make relationships. So there's that possibility. So if it's possible for you to measure a relationship directly, you might find something different. That's my little contribution. Thank you.
Yeah, thank you. That's a very good question, but it's very hard to measure these relationships. And, yeah, because they're like, it's very, very difficult to measure them. So, I mean, we actually did that in another paper, but it's like crazy to find whether, the company has something in common with a government official and stuff like that. I mean, it would be good if it were like so possible, but it's really complicated. And yeah.
Understand. Yeah, indeed. Yeah. Yeah. So there are some papers on China. They look at the political connections. They look at and things like that. But you are more general when you are talking about relationship building. It's not necessarily with official, but maybe bankers, maybe other networking members. So that's. Yeah, indeed. There's no direct index for that. So, any more questions, colleagues? No? And I really, first of all, I thank you, Alessandra and Dongqiang, for your patience at the beginning of today's seminar due to the technical issues. And then we calmly carried out everything normally. So very, very, very good performance for the presentation, for Q&A sessions. And thanks, colleagues, for your contributions in terms of the interaction and the questions. I think we all have learned something from this, from the discussion and the presentation. So Alessandra, maybe one sentence to close this?
Yeah, I would like
I close this.
Yeah, I would like to thank everybody for attending the seminar and for like the very insightful questions. I mean, as I said, like the presentations that I give here usually bring luck to the paper, so we will incorporate the comments and hopefully get a good publication once again out of one of these seminars. So I'm really very, very grateful for this. And, thank you so much.
Always, Alessandra, very, very good papers. So thanks, everybody, and I will see you then next Wednesday.